You can get bitter or you can get wise. And today we want to get more wisdom in your hands to help you navigate this. And unfortunately, the wealthier you are, these rules a lot of times don't benefit you as much as the ordinary folks, but we're all about both people. Any way we can figure out how to help both of those, we're going to bring it to you.
Welcome to the Up Your Average podcast, where Keith and Doug give no-nonsense advice to level up your life. So buckle up and listen closely to Up Your Average.
Good morning, Gimbal Gang.
We are all three here. Last week, technical difficulties. I think the answer was I didn't have my sound settings right. So you guys were right.
Man.
But welcome back, everyone.
We did a tour of Wall Street for you, mainly of the New York Stock Exchange area and some of that history. And you could go back in our recorded ones. And you and I did that about 2 years ago. And I was sitting on the steps at the JP Morgan Bank, and a homeless dude was smoking pot, talking to me the whole time. It was a classic moment.
I think we've addressed this before, but the JP Morgan building is my favorite, and kind of like a letdown, an extreme letdown, but a win for capitalism. Is I went to the JP Morgan building. Maybe you were with me, Keith, but at the moment it had turned into a Halloween store.
I don't even think it was open, was it, Caleb?
It was doing renovation or something.
Like, there are some things that you just shouldn't do that with. I love capitalism and all that, but there's some areas where you just got to preserve the greatness.
We should research who owns that now, because if the family owns it, surely the Morgan family wouldn't let that happen.
I don't know.
Yeah,
I doubt they own it.
Yeah, because that'd be like turning your property into a brothel or something. I don't know.
It was a sad moment, but on the plus side, it did allow me to go inside and check it out.
Yeah.
So that was pretty cool.
Yeah, I like that. I don't think it's never been open where I could do that when I've been there. That part would be cool.
That was a win.
So I was doing a little research for our conversation today, and a number of years ago, there were these people that they started throwing tea in the harbor in Boston. You heard that story?
Yeah, and it didn't take much.
It
didn't take much to tick them off, is what I'm saying.
6 to 8% taxes is what they estimate. Can you imagine that if our country got upset about paying 6 to 8% in taxes, the revolution we'd have? It would be unbelievable.
Yeah,
it would be unbelievable. So as we were preparing this conversation, I was going to get a picture of Mini-Me, and a backpack is kind of what I think of. Like you got to hoist this thing on and carry it around. But if you look at a number of your investment strategies, you've got a Mini-Me on your back. If you haven't seen the Austin Power movies, pretend like I haven't either, but you're hauling another stakeholder around.
Okay.
Right?
Yeah, good choice of words.
Yeah, and they don't have any risk.
Yeah.
And so I think if I were going to say the gist of what we wanted to talk about today is disinheriting an unwanted heir. Like, how can when I look at my traditional IRA or my traditional 401k, I'm hauling around Mini-Me, which is your U.S. federal treasury or your state income taxes, or maybe if those of you that are in California, you may have to pay it on your city and county, who knows? And so the more you grow those accounts, you may think you just have your 2 kids as your beneficiaries, but you've got a third beneficiary, and that's the government. And the more it grows, the more they're going along for the ride.
So true. Like, you think of it even with your house, your home, and the taxes you're paying. The municipality is always the winner. They have no risk in your house.
I literally just hit the pay for this building here.
Yeah.
And it is almost 3% of what we paid for the building is what I have to pay every year.
Oh, Mayor Sue thanks you.
Yeah, I take it back. It's 2%. So That's still
But it's a
lot.
ton.
Yeah, and it's so much because we took our capital and put it into this.
Your capital.
We put it into the building to make the building presentable. So once we made it presentable, they were still in the backpack. They're like, "Good job, spend some more capital so we can assess that at a higher value."
Yeah.
So that's the nature of the
what
game.
we're talking about.
That's the nature of the game, and you can get bitter or you can get wise. And today we want to get more wisdom in your hands to help you navigate this. And unfortunately, the wealthier you are, and these rules a lot of times don't benefit you as much as the ordinary folks, but we're all about both people. Any way we can figure out how to help both of those, we're going to bring it to you on a Friday morning.
Our worldview collectively is, hey, render unto Caesar. Plus, we love America. We love living in America. It's the best. Plus, let's be pretty shrewd. Let's be shrewd with what we've got.
I was explaining that to my son-in-law, Kevin, last night, that neighborhood associations are another form of Caesar, right? Like the neighborhood associations, but so you have your federal, your state, your city, and then an association. They start constraining the liberty, but they're also charging you a tax. Yeah. And I've heard some of those, like in people in condos, the fee for those get pretty gnarly.
Yeah. Yeah. Well, let's get into today's topic, which I am thrilled to have Caleb joining us today. Really, this topic was born out of a meeting that Caleb and I had with one of our clients. And Keith, you and I were talking earlier that most of our great ideas in business life come from our clients. They come from someone else raising their hand and saying, "Hey, can we do this?" And then it's our love and responsibility to go after it. And so Caleb joined me in a meeting this week, and he brought his expertise and really, I think, can open some new doors for people that might help them save a little money from Caesar.
Can I brag about Caleb a little bit?
Yeah.
Is that allowed?
Well, tell everybody like why. Yeah, brag on him.
Well, I mean, the fact that he's my son is worthy enough. But when I was in college, the accounting classes were really those were the ones to kick you back into marketing or management or something like that. Like,
right.
Those were the classes that separated the people that really had the gist of what business is. And I had, if I'd had a minor, it would have been in accounting, and I kind of liked it. We've got a puzzle out there on the counter. Accounting's kind of like a puzzle. The pieces have to fit in a certain way, and it tests your brain that way. And we were visiting, I think you were at this meeting in Chicago, the guy that owned the last pinball machine manufacturer. I can't think of his name right now. But he had a kid at IU, and he was talking to us, and he said, "Accounting is the language of business." And I thought that's a great way to look at it. So accounting is the language of business. Caleb went through, I think, all the accounting classes at Murray State with A's. Is that right? Straight A's? And Were you the top accounting student?
Probably not.
What is the hardest accounting class?
It was advanced accounting, which entails, I think it's business returns, but consolidated tax returns. It's like if Amazon owns a subsidiary, that subsidiary's information has to be in Amazon's return. So there's just a lot of information to memorize and different techniques, different ways to do the same thing. And there's some mythological accounting things that go on in those kind of businesses, Doug, like the subsidiaries sometimes buy stuff from the mother company, and the pricing and all that stuff gets really squirrely. And so the fact that people have the brains to be able to organize that stuff is insane.
Yeah, very cool.
Yeah, so that's my introduction and my bragging on Caleb. But I think it's important for you to know that you have access to this brain with a quick phone call. If you're looking, he's not a CPA.
We're not looking to replace anybody's CPA. We don't even do taxes here.
Yes, we did that at one time.
And we're not planning to go back.
We've been there, done that. And probably another plug before we jump into this is I was talking to a tax professional sometime earlier this year. And the process is, I think it costs them, I forgot what he said, between $100 and $200 a return to the technology company just to have the software. So like the licensing is a good percentage. So if you're paying a couple $100 to your accountant for your taxes and he's doing it on a system, he's probably not making much. So appreciate what they bring to the table because it's a big deal.
Absolutely. Yeah. I love the confidence of a CPA. Yeah. And so these ideas that we're going to bring in front of you today, feel free to consult with your CPA and give us feedback on your situation. But I will tell you, I may have snoozed through an accounting class, but this one just gets me really excited because for some people, it's like free money.
Yeah.
And they don't even know it. So let's dive in. This is the senior bonus deduction. Are we sharing the screen, Keith?
We are. You ready for the next one, Caleb?
Yep. All right. So this bonus deduction came into play this year with one big, beautiful bill.
Which anytime the government starts getting cute with the name of a bill, I always like flip-flop it to it's the exact opposite. Like the Affordable Care Act, not so affordable.
Well, what was the one, the inflation, when they did recently, the Inflation Reduction Act or something like that?
Yeah.
And it's like, oh my, I better go buy some more gold.
Cash for clunkers. I mean, the marketing department is weak, but this was Trump's one big, beautiful bill.
I think Ronald Reagan said, if whenever they say we're here from the government to help, grab your wallet.
Yeah, exactly.
Sorry, Pam.
Yeah, no, I digress. Okay.
Yeah, so this is the first year with this, and it's available to anyone who's over 65 years old by December 31st.
Okay.
And it's a $6,000 deduction per person. So if you're married and filing jointly and you both are over 65, that's $12,000 just on top of whatever you had last year. And the cool thing about this is if you're itemizing or taking the standard deduction, you can take this deduction.
Yeah, that's pretty unreal.
Yeah.
To be able to have it for both groups.
For sure. And all I saw was you just have to have your Social Security on your tax return, which you typically do. And the one thing is, I think if you're married, filing separately, you do not get this deduction.
Okay.
And as of right now, it's only in place until 2028.
Gotcha.
They can renew it, but that's not guaranteed.
Right.
I'd throw this in there. If you're married and filing separately, maybe you should sit down with your accountant and talk about that anyway. You're going to pay higher taxes, and every time I've looked at that, it just doesn't make sense to be married and filing separately. And I know there's probably some reasons involved there, but you're probably going to save your family money if you can negotiate to file jointly. Here's another example of it, right?
All right. And there's a phase out to this. So like my dad mentioned earlier, that the higher income earners probably won't benefit from this. But you take it's based on your modified adjusted gross income, which I didn't remember exactly what that was based on my tax classes, but it's basically your adjusted gross income, which you can find on your tax return, plus some add backs, which some of those are IRA contributions, tax exempt interest, or your Social Security benefits. But for example, if you're married, filing joint, and say have a modified adjusted gross income of $200,000, you would typically get the $12,000 deduction, but you're 50% phased out of this, so you'd only get $6,000 of the $12,000.
So if you're under $150 a year, you're good.
You should be good,
which is pretty generous phase out amount.
Yeah.
So if you're making with your IRA distributions, if you have a part-time job, if you have some taxable income coming in under 150,000, this is for you.
Yeah. And even if you're under 250, you still get something.
Yep. Good work.
So this is just a chart of all the deductions that a 65-year-old can get. We've got the different filing statuses, and those are, I think, the 2025 numbers. So you have your standard deduction, and then there's another deduction for people over 65, or if you're blind, or both. That's where the differences, like between 1,600 and 64, that's where that comes in.
And these standard deductions really got ramped up a couple years ago. I don't remember when, but they really soared a couple years ago, where not too many people itemize their taxes anymore.
I think it was during the first Trump administration is when that happened. And the theory, I think, was you wouldn't have to hire as many accountants anymore, but I still think it's so complicated you do.
Yeah.
And so, yeah, I think that's when I remember it happening.
So those total deductions for somebody 65 plus, if you're driving down the road, I'll just give them to you right now. You're looking like somewhere around 23 grand to 25. And then if you're married filing jointly, 39 to 49.
Yeah.
It's pretty huge.
That is a lot.
And that includes this new bonus deduction. Single, again, 6 grand, married filing jointly, each get it, 12 grand.
Yeah.
Yeah.
And I think if you get the 12K deduction and then some of the additional, I think it's just under 47.
Yeah.
So it's quite a lot.
That is beautiful.
Onward.
Onward.
Oh, it's Paul Williams.
Look at that.
Well, how do I change this, Caleb? Can I change it? It's Bridget.
Well,
he's not Mormon, is he?
Well, Bridget.
Oh, did he say that?
Bridget passed away.
Oh,
that way I'm Becky. Becky's in the picture now.
All right. And because there are characters, just because he was 60 a few weeks ago doesn't mean he can't be 68 today, right?
Or that Bridget can't change her name.
That's
right. We'll go by the middle name. Good job.
That's right.
Bridget Rebecca.
So in this example, we've got Paul Williams, 68, Becky Williams, 67. Tell us more about them, Caleb.
They're both retired, so they don't really have any income coming in. And their yearly Social Security income's around $41,000. And then for our listeners, I just put some numbers on there. So they had an IRA balance of $475,000 and a Roth IRA of $70,000.
Okay.
And tell us a little bit the difference between a traditional and a Roth IRA.
You want me to go?
Yep.
Yeah. So the IRA is coming from, is it pre-tax dollars from your, pre-tax dollars. So you put money in and it can grow, but whenever you have to take the money out, you're going to be taxed at whatever your ordinary income bracket is. Your Roth IRA, you've already been taxed when you've earned your income. Then you put that money into your Roth IRA and it can grow tax-free. So when you take the money out, you don't pay taxes on it at that point.
Right. Yeah. And most folks in their 60s right now, they have traditional side IRAs because the Roth really wasn't available for them. Definitely wasn't available for their 401ks, which, now that is available. So
Yeah.
the majority of the people we'd be talking about are addressing for this senior bonus deduction have large IRA balances.
Yeah.
All right. So they've got 70 in the Roth and 475 in the traditional. What are we going to do here, Caleb?
Yeah. So there are two different scenarios that we thought of with being able to convert some of that IRA money into your Roth to let it grow tax-free. The first scenario is to just use as much of those deductions that you can. So in that, if you go back one screen, they had about 41,000 of income, but most or all of that is not taxed. So their taxable income is, I think, zero, or I guess their adjusted gross income is zero or around it. But that's without using any of the standard deduction, the additional, or the bonus. So Paul and Becky would have about $40,000 to $50,000 of deductions that they didn't use.
Okay.
And most people just let those slide by.
Yeah.
So we're assuming what is their taxable income right here then? Because that's what we're going to see on the marginal rates, right? The
If your
taxable.
Social Security income is 41,000.
You're saying zero of that's taxable?
Yeah. Or even if a portion of it is taxable, you have 46,700 of deductions that offset whatever is taxable.
Okay. And so whenever you see your marginal tax brackets like this is looking at your taxable income, not your total income or adjusted gross income. It's after all those things have been withdrawn from your total income.
Right. And
so we're going to look at this middle column for,
yeah. And before we look at that, Keith, we did a podcast. It might have been 2 years ago, maybe a year ago. I can't remember.
It's podcast number 40, number 3.
Are you serious? You had that?
Up your average. Yes. I'm here to help.
Dude, that is awesome.
Yeah.
Okay. So podcast, what was it?
Number 3.
Number 3.
You can go to YouTube or wherever you get your podcasts.
Okay.
And we talked extensively about marginal tax rates.
Yeah, we did. And Keith was high on this. It was awesome. We were talking about there's a few tax rates. You've got a 10%, 12%, 22, 24, 32, 35, 37. And so the one that Caleb was wanting to focus on that I think is so good is most of these move up gradually, but that 12 to 22 is a huge jump. And that's what you addressed on the initial podcast.
Right. Because what the government would like you to think is that's only a 10% increase, but it's 10 percentage points. It's almost 100% tax increase. Right. And to me, that's the most diabolical part of the tax code, because that is nailing the lower income people hard. Like that's really putting it to them pretty aggressively. And then you can see there's staggered increases beyond that, but that big step is that's a tall order.
And so most of our clients who would take advantage of this senior deduction fall somewhere in between those two.
Well, and you probably, you could get all the way up right to the 24. Is that right, Caleb? Is that, you said 250?
250, you might, with those add backs, it might push your.
Okay.
So it's probably 22%.
Okay.
So, and if you're driving down the road, the 12% bracket goes all the way up to 48,000.
For single, yeah.
For single, thank you. And the married is 97,000. Okay. And so the jump to the 22 starts at 48 and goes to 103 for a single filer, and starts at 97 for the married filing jointly and goes to 206.
Yeah. So going back to the first example, when they have, say, 40,000 of unused deductions, you can convert $40,000 of your IRA to your Roth and still have a $0 taxable income and not pay taxes.
So you're saying this would be essentially a tax-free Roth conversion for the Williams family?
If they just went up to use their deductions, yes.
Okay.
Yeah. Boy, that is like a Pacers starting five layup right there.
Yeah. And the other example is, like you guys were talking, the big jump from 12 to 22%. It's maximizing those lower tax brackets. So going up to that 97,000 for the married filing jointly, or the 47,000 for the single filers. And with this example, you still get your deductions, and then you're going to pay a little bit of tax, about 10% or so, on the excess that you go past your $0 of taxable income.
So who wins in this scenario is something I think about. And I think, well, whoever's doing this, you win, because you're paying a little less tax than you would to get money out. The big winner in this is your spouse, because when you die, your spouse moves from the married filing jointly the next year to the single filer. And so the tax rate bumps up.
Yeah.
And so to have some Roth money as an option to take out is a big win for your spouse. And then the big winner is your future generations, or whoever you want to give this money to have money in a Roth would be a wonderful thing to inherit.
Yeah, and that's why I have the backpack here. Is the Roth money has no backpack. There's no, you prepaid Mini-Me, you prepaid the backpack, and you took it off of those assets, and there's no taxes. And the heirs, now they have 10 years to get the money out of the Roth once they inherit it.
So something I hear quite often from time to time is, Doug, I don't need to leave my kids any money. They're making more money than I am. Do you ever hear that? And so the thought is, well, okay, that could be true. And if they are making more money than you are and you didn't spend it all, they're going to really love that gift because they're in a higher income bracket than you.
Right. Yeah. So I've talked with Caleb about this a little bit. Maybe you and I've talked about family wealth. And when you look at multi-generations, you're saying, how do we get the most wealth for the generations? That may fit into your mindset. You may want to do a Roth conversion, even if you don't qualify for this deduction, because there's some benefits to the heirs for doing that. Because we've got a chart. If you're ever in Gimbel's kitchen here, you can see historical tax rates, and the government can raise them high enough that you may want to start throwing some tea in the harbor.
Yeah. And so on the Roth conversions, it may or may not be right for you, but we would be happy to take a look at it. We're not CPAs, so we'd be happy to take a look at it. Bring your CPA in on it. And I think for your financial consultant, if you're working with somebody, you might try and get this done before the first week of December, or else your advisor's eyebrow might start twitching.
I told somebody this week, the 15th of December, we will help you up until the 15th of December. And then it's a coin toss whether it'll get done. Yeah, we prefer, because we love Libby and Amanda, you do it before December, but
yeah, it's a timely thing.
Yes. What else do we need to know about why do a Roth conversion, Caleb?
I don't think much. I mean, one other small thing is Roth IRAs don't have RMDs.
Good call.
Yeah, so you can, by using the Roth conversion, you can control your income better by getting more money out of the RMDs, because that math is, the older you get, the more you have to take out of this thing. And if you can convert some of that younger to the Roth, it may give you more control of your taxes in your later years.
I think another plus is that if you do have a lot of money in IRAs and you do need to go to some type of assisted living scenario, taking it out of a Roth is a much less painful experience than taking it out of the traditional.
I would say the other thing to keep in mind with this new deduction is bunching. and we say that every once in a while, but if you itemize, then maybe you think about overextending what you're giving to the charity, say, for example, in 2025, and then cover your 2025 or 2026 gifts to those charities in 2025. So you jump up your total deductions. So you get that plus this senior deduction. And then next year, you could probably take both the standard and the senior deduction. So bunching's the idea of, maybe in December, you hold off on those gifts and give them January. You choose which year you want to bunch those gifts in. But that's an idea that is worth keeping in mind if you're right on the fringe of getting the standard deduction or not getting it. Anything else that we need to say?
Man, that was actually pretty fun.
Yeah.
Yeah. I think you should take this to the Murray State tax class, and those kids would just be riveted. They'd be so excited.
I know I am.
I'm excited to help people.
I am too. And I'd say the last idea of getting the backpack off your back that I'll throw out there as a toss in today is if you do have charitable desires and you're aging and maturing and you have some things in your estate that are going to charity, maybe do them from your traditional IRA or traditional 401k, because your family would much rather get the Roth and those backpack type of tax things, because your stuff that's in your own name, you'll get a step up on death, your cost basis on death. The IRA, it's carrying those taxes to the next generation. So if you want to give to charity, talk to us about naming those charities as beneficiaries.
If this podcast is sparking interest, but it's a little muddy for you still, just give us a call. And we would love to pair up a conversation with you.
And not only that, if this podcast is sparking curiosity, send it out to all your friends. You guys have a great weekend. It's good seeing you.